Hey, it's Eric Osnes with Homebridge Financial with my weekly update on mortgage rates and the economy, what the heck's going on out there. Listen in every week. I try and give you an update, although I'm a little late on this one. Normally, I send this out on Fridays and just got a little bit too busy Friday and over the weekend. So here we go with an early week update on what's going on in the mortgage markets. And last week was another rocky one in the financial world as we seesawed between rally and panic. The markets are still really weighing on this deepening crisis in Ukraine and also rising oil prices. I hadn't filled up my tank for a couple of weeks and was, pretty shocked when I did that over the weekend. So everybody's feeling the pain of this worsening inflation. This week on Tuesday, the producer price index will be released, and it's expected to come in at over 10%, one of the highest numbers ever recorded. The producer price index is a leading economic indicator. It's what manufacturers pay for the price of raw materials and components they use to build stuff. And those costs will most surely be passed along to you as the consumer. Also, this week, the Federal Reserve Open Market Committee, the FOMC, is meeting Tuesday and Wednesday. On Wednesday, they'll make an announcement on interest rates. We are expecting them to increase rates 0.25%. Don't worry, though, that expectation is already cooked into today's mortgage rate, so we won't expect any huge impact from their announcement unless they say something that scares the markets, which is always entirely possible. They raised the federal funds rate. Federal funds rate is a very short-term rate, but it influences the rates on things we pay on like credit cards, car loans, and really any loan tied to prime rate, especially home equity lines of credit, unless you have a fixed rate home equity line of credit, which I do, by the way. Ironically, when the Fed increases the federal funds rate, it can actually help calm long-term mortgage rates because it's seen as combating inflation. Um, but is now a good time to raise rates when consumers are already suffering, at the grocery store and, like I learned, at the gas pump? Well, the Federal Reserve doesn't have a lot of tools, and one of the tools they have to fight inflation is the Fed funds rate. They fight that by increasing rates, which puts the brakes on the economy. It slows it down, and that in turn will help calm down inflation. What does this mean for mortgage rates? Well, in the short run, it means we could see rates continue to rise just a little bit. We don't expect things to go too crazy, but then as the economy slows, interest rates will fall. Some economists right now are forecasting that we could see our economy dipping into a recession as early as later this year. So we'll be watching for that because the rates will follow the economy. If the economy dips into recession, doesn't necessarily have to mean it's Armageddon like what we had a decade ago, but we would see the economy slow, and that could actually lower interest rates. So far for last week and so far this week, rates are higher fairly sharply. Here's the national averages for 30-year mortgages. A conventional 30-year fixed rate, 4.38% up from 4.09 last week. Conventional 15-year fixed rates 3.69, up from 3.41% last week. FHA and VA 3.88, up from 3.63% last week. Still really good for FHA and VA. And jumbo 30-year fixed rates also still pretty good, 3.85, up from 3.63% last week. So, with all this talk about inflation, higher rates, the possibility of recession in the near future, should you adjust your home buying plans? The short answer, at least in my opinion, is hurry up. And the answer is no, you shouldn't adjust it. It's true that inflation and higher rates are going to affect your buying power. Just a 1% increase in rates on a $2,500 mortgage payment takes away about $70,000 in buying power. Don't plan on a housing bubble in the Northwest anytime soon. That's because we have a severe shortage of housing in our region, and even nationwide for that matter. Nationally, there's a demand for housing exceeds the supply by about 4 million units. It's going to take a long time before that demand can be satisfied, especially given the supply chain constraints we're dealing with right now, labor shortages, and in our region, we just naturally have a a limited amount of land to build on. Personally, I have not seen a real estate transaction without multiple offers on it in over a year. Demand remains really, really strong and is expected to stay that way. It's tempting to compare our experiences in the housing market from a decade ago to now. Back then prices fell up to 35%, but that crisis was fueled largely by irresponsible lending, zero down loans, stated income loans, subprime loans, and excess inventory, which we definitely don't have now. When the economy slowed back then, homeowners had little or no equity in their homes. And if they had to sell, that resulted in short sales and foreclosures, further exacerbating the problem. Homeowners today have tons of equity, and most would be able to sell their home at a profit if they ran into personal financial struggles. People are going to continue moving into our region as well. We have jobs, we have education, and we'll just look out the window. It's a beautiful place to live. That's not going to change, even if it's a little bit more expensive to live here in the short run. And if a recession hits, rates will fall, creating the opportunity to refinance into a lower payment. I hope this information is helpful. I'm always available to answer questions and your individual story problems. You can reach out to me anytime. Just call me 206-915-ERIC. You can email me, eric@ericismybanker.com. We've got a weekly radio show on AM 1590 at 2 p.m. on Saturdays and 3 p.m. on Sundays. And that's also available anytime on podcast. Just search Open House with Team Reba. Hope you have a great week. Just reach out if I can answer any questions. We'll talk to you next week.